Power moves markets. Capital shapes the world. This is Behind Capital.
The moment after Lehman. September 15th, 2008. Lehman Brothers files for bankruptcy. Global markets enter panic. Credit markets freeze. Confidence disappears. But within 24 hours, regulators identify a threat even larger than Lehman. An institution with more than $1 trillion in assets is running out of cash. Not a bank. An insurance giant. American International Group. AIG. If AIG collapses, the crisis will not remain contained. It will cascade. This is the inside story of how an insurance company became the center of the global financial system, and why the United States committed $182 billion to prevent its failure. The architecture of AIG. Founded in 1919, AIG grew into one of the largest insurance conglomerates in the world. Before the crisis, operations in over 130 countries, 116,000 plus employees. AAA credit rating from major agencies. Over $1 trillion in total assets. Roughly $100 billion in shareholder equity. Its traditional business lines were diversified: life insurance, property and casualty insurance, commercial risk coverage, aircraft leasing through its subsidiary, ILFC. In ordinary conditions, AIG generated stable cash flows, but beginning in the late 1990s, AIG expanded aggressively into financial derivatives, specifically through AIG Financial Products. This division would ultimately determine the company's fate. The business of selling safety. AIG Financial Products specialized in over-the-counter derivatives. Its most profitable product was the credit default swap. ACDS functions as insurance on debt. If a bond issuer defaults, the CDS seller compensates the buyer for losses. During the housing boom, investment banks created mortgage-backed securities. These securities were then bundled into structured products called CDOs, collateralized debt obligations. Investors demanded protection. AIG provided it. Between 2004 and 2007, AIG wrote hundreds of billions of dollars in CDS protection on structured mortgage products. The logic was simple. Housing prices had never declined nationwide in modern U.S. history. Defaults were assumed to be regionally isolated. Risk models showed low probability of simultaneous nationwide collapse. The premiums looked like free money. For years, it worked. The hidden leverage. By early 2008, AIG had written approximately $440 billion in total CDS contracts, $79 billion directly tied to subprime-related CDOs, more exposure linked to corporate debt and other structured instruments. Here is the structural flaw. AIG did not post full collateral up front. Because of its AAA rating, counterparties required minimal initial margin. This meant AIG effectively operated with embedded leverage. The contracts contained downgrade clauses. If AIG's credit rating fell, it would be required to post additional collateral. When mortgage securities were downgraded, AIG had to post billions in additional margin. When AIG itself was downgraded, the collateral demands multiplied. This was not primarily a solvency crisis. It was a liquidity crisis. The assets existed on the balance sheet, but cash was required immediately. And in a frozen market, cash is everything. The liquidity shock. After Lehman collapsed, financial markets entered extreme stress. Counterparties no longer trusted institutional stability. Collateral demands accelerated. AIG faced over $30 billion in immediate liquidity requirements. Potential exposure was far higher. The company's stock price collapsed from approximately $70 in 2007 to below $5 in September 2008. Rating agencies downgraded AIG. Each downgrade triggered additional collateral calls under CDS agreements. This created a liquidity spiral. AIG was not insolvent in a long-term accounting sense, but without immediate funding, it would default on its obligations, and a default would trigger cascading losses across the banking system. Systemic risk transmission. Unlike Lehman, AIG's exposure was not limited to trading counterparties. Its CDS contracts were distributed across the global banking system. Major institutions exposed to AIG included Goldman Sachs, Morgan Stanley, Deutsche Bank, Barclays, Société Générale, and numerous European financial institutions. If AIG defaulted on its CDS contracts, banks would need to mark down billions in assets. Capital ratios would deteriorate. Some banks could fail. Money market funds, already destabilized by Lehman, could break again. Interbank lending markets could freeze entirely. The Federal Reserve and Treasury concluded that AIG represented systemic contagion risk. This was not simply about saving one company. It was about preventing a collapse in financial plumbing. The rescue structure. On September 16, 2008, the Federal Reserve extended an emergency credit facility of $85 billion. In exchange, the U.S. government received a 79.9% equity stake. AIG's CEO was replaced. Government oversight was imposed. Over time, total support reached approximately $182 billion through multiple mechanisms: direct lending facilities, the creation of Maiden Lane III, a special purpose vehicle that purchased toxic CDOs from AIG's counterparties, asset guarantees, debt restructuring. Maiden Lane III was particularly significant. It allowed the Federal Reserve to purchase distressed assets at negotiated prices, removing immediate collateral pressure from AIG. This stabilized the firm's liquidity position. Effectively, AIG was temporarily nationalized. Political backlash. Public reaction was severe. Why rescue AIG after allowing Lehman to collapse? Treasury officials argued that Lehman lacked sufficient collateral to support emergency lending under Federal Reserve authority. AIG, by contrast, possessed underlying asset value that justified intervention. Critics claimed inconsistency. They argued that allowing Lehman to fail intensified panic and forced the government's hand with AIG. The controversy deepened when AIG paid retention bonuses to executives within its financial products division. Public trust in financial institutions eroded further, but policymakers maintained that the bailout was necessary to prevent systemic breakdown. Resolution and exit. Over the following years, AIG sold subsidiaries, reduced leverage, and unwound derivative positions. Non-core assets were divested. Risk exposure was significantly reduced. By 2012, the U.S. government exited its ownership stake. Remarkably, taxpayers recovered the bailout funds with a modest positive return. However, the broader crisis reshaped financial regulation. The Dodd-Frank Act introduced enhanced capital standards. Systemically important financial institutions were subject to stress testing. Central clearing requirements were imposed on many derivatives. Liquidity coverage ratios were strengthened. The global financial architecture changed. Final reflection. AIG did not collapse because insurance underwriting failed. It nearly collapsed because risk concentration and liquidity dependence were underestimated. It assumed housing markets were uncorrelated. It assumed counterparties would always provide funding. It assumed stability would persist. In 2008, those assumptions collapsed simultaneously. The $182 billion intervention was not a rescue of an insurance company. It was an attempt to preserve systemic continuity. The enduring question is not whether bailouts occur. The question is whether interconnected risk has truly been reduced.